So welcome to Synchronous Session 3. We are going to be looking at Chapter 3 this week and talking about adjusting entries. And the really good thing about this week is that we slow down and we kind of spend extra time understanding adjusting entries and reviewing journal entries, because so far you have learned, or you are learning, right? I've introduced to you, you've been introduced to all of these new account names, the accounting equation, each one of the financial statements and what's on them, and then how to write down a journal entry with debits and credits, which is, that's in 1 week. This is a lot. So the good news is that as we do adjusting entries, which are just a special type of journal entry, we'll be talking about how those work and also how regular journal entries work. So you'll get a lot more practice with the account names, debits and credits, and all of those concepts. So it will make the rest of the course a little bit easier. So I've just pulled up your practice problems for this week. And we're starting here. Am I sharing my screen where it says exercise 3-3?
Yes.
Okay, perfect. So these are adjusting entries, and we're going to work through the adjusting entries, but we'll also talk about like what happened before the adjusting entry. We're also going to be using T accounts. Remember, we had talked about T accounts a little bit. We're going to be using T accounts the way they would really be used in the real world to see the flow of dollars and cents as we do adjusting entries. So an adjusting entry is a special type of journal entry because the sole purpose of adjusting entries are to put the revenue and the expenses into the correct period. That's the entire reason why you're doing an adjusting entry, is you want to put the revenue and expenses in the correct period. So what that means is one of the things that you'll notice when you're doing adjusting entries is that you will never use the cash account. You're never, ever going to use the cash account for an adjusting entry. If you find yourself thinking that it should be cash, you're doing something wrong. You will always have either a revenue or expense account, and you will always have a balance sheet account. And as we talk about them, you'll see why. Because the revenue or expense, the very purpose of the entry is to put the revenue or expense in the correct period. And then the other piece that gets affected is either an asset or a liability. Okay, so the first entry here is the only one that we're going to talk about that is an entirely new concept with new account names. So the very first entry, we're doing what's called recording depreciation on the company's equipment. So they give us the amount, but depreciation is an interesting concept. So let's say that we bought a building, and let's say that the building cost $500,000. So according to the historical cost concept, when we buy the building, we're going to put it on our balance sheet as an asset at a value of $500,000. Now, a couple of things happen. But the biggest one is when we put it on the balance sheet at $500,000, we've recorded it all as an asset. But that asset is going to use revenue for us, earn revenue for us. And we know that one of our rules is that we have to match revenue and expenses. And by match, I mean put them in the same period. Like we want the expenses that are related to earning that revenue in the same period as the revenue, which makes it a lot easier to see, what's your real net income. So with this building, we've put it on our balance sheet at $500,000. That building's going to earn revenue for us. It's going to house all of our equipment, our people. It's going to earn revenue for us. So our building's on our books at $500,000, but it's earning revenue for us. So we want to match the revenue that's being earned by that building. We want to match that revenue with the expense of the building. But the only expense that we've had was the $500,000 that we put down to put it on the balance sheet. So what we're going to do is we're going to use a new account, a special account, and that account is called Depreciation Expense. And what we're going to do is we're going to say, okay, let's say this building is $500,000 and we expect that, we're going to be able to use it for 20 years. We're going to say, okay, so we're going to take 1/20th of that expense, of that $500,000, and we're going to expense it as depreciation expense every single period. So then what's going to happen is we're going to record depreciation expense. That's going to go on the income statement. The other account is also a new account, and it's called accumulated depreciation. I promise I think they're the only two new accounts this week. So we have accumulated depreciation. All right, so depreciation expense is an expense account. Accumulated depreciation is a new type of account. It's what's called a contra account. And this one is a contra asset account. So contra means the opposite of. And so this account is a type of asset, but it has the balance opposite what a normal asset would have. So if a normal asset has a debit balance, accumulated depreciation has a credit balance. And so what we're going to see when we record this entry is on the balance sheet, we're going to see like building is, $500,000 because that's the cost. And then we're going to have less whatever accumulated depreciation we've recorded. So that's $100,000 so far. And what's left over, this $400,000, this $400,000 is called the book value. The only reason it's called the book value is because it gives us the net value on our books of the building. Because on our books, we have building less accumulated depreciation. This has nothing to do with the market value or resale value. It has absolutely nothing to do with any of that. I think we get thinking that way because we're used to thinking about cars for depreciation, and then we think about the blue book value, and we're used to things showing, market value. But all we're doing is we're going to record depreciation expense, and we're going to credit accumulated depreciation. The expense will go on our income statement to match with the revenue, and on our balance sheet, this accumulated depreciation account will grow, and the book value will decrease. All right, so let's look at the journal entry. So for this first one, we'll scroll down because we've already gone over the account. So for the first one, we have depreciation on the company's equipment for 2017 is computed to be $13,000. So you're going to ask yourself, the thought process of what two accounts are affected. And we just did those. So we know that it's depreciation expense and accumulated depreciation. Did depreciation expense increase or decrease?
Increase.
It increased. We have more expense now than before. Did accumulated depreciation increase or decrease?
It increased, right?
It increased also. What type of account is depreciation expense?
Expense.
Mm-hmm. What type of account is accumulated depreciation? I'm going to help you because it's new.
Contra.
The contra asset. Yes. If I increase an expense, do I debit it or credit it?
Debit.
Yep. If I increase an asset, do I debit it or credit it?
Debit.
So I debit it. So since it's a contra asset, I'm going to do the opposite. I'm going to credit it to increase it.
Oh, that's right.
Because it's contra. So my journal entry is going to be depreciation expense equipment for $13,000 and accumulated depreciation for equipment, $13,000. And when I'm done with that, on my income statement, I've recorded an additional $13,000, and on my balance sheet, I have reduced the book value of the equipment by $13,000. All right, does that entry make sense? You're muted, Kiana.
I think we're having a problem with your mic. I think everybody else's mic is.
Can you hear me now?
I can hear you, but it's some noise in the background that keeps going
Sounds
on.
like there's a helicopter on here with us.
Yeah.
I don't know what that is.
I don't know either. I'm sitting here in a completely quiet room. Let me see. Let me unplug and plug back in to my phone.
Yeah, it just stopped.
Yeah, stop.
Does that do anything?
Yep, sounds good.
Audio.
Yeah. I think we're
Okay,
good now.
better? Okay. Oh, phew. I don't know what the problem is with my headset. I'm still trying to figure that out. I haven't had a problem in 10 years. And it's not the headset. I mean, it is, but it's not the headset. I don't think. Nah, it worked the day before it stopped working. Okay. Next one. All right, so the next one. Now we're gonna think prepaid insurance. So now we're gonna use T accounts, and I want you to think, because we have to go back to like the beginning. So we have prepaid insurance. So we want to think about what was prepaid insurance. So prepaid insurance is when we pay insurance in advance. What type of account is prepaid insurance?
Asset.
An asset. So it has a $6,000 debit balance right now at December 31st, before any adjusting entries. All right, so what this tells me is we paid $6,000 in advance for insurance, and that's sitting on our balance sheet, right, as an asset. Now, we use it up over time, and as we use it up, it's an expense. So this says, before adjusting for the cost of any expired insurance, an analysis of the company's insurance policy shows that there's $1,860 of unexpired insurance. So what that means is, right now at the end of the period, we have $1,860 worth of prepaid insurance that we haven't used. So the first question is, does the information make sense? We bought an insurance policy. Mm-hmm.
It leads you to the 4140, which is what you're going to need to actually use.
Thank you. So that was my question. Was going to be my question. How do you get from the 6,000 to the 1,860? Well, we have to credit 4140. What does this 4140 represent? And I think you said it
Insurance
for us.
expense.
Yes. This is our insurance expense. This is the amount that we have used. So we prepaid it, and now we're going to record the expense for the part that we've used. So when I said that it's, you'll see how it's an expense account and a balance sheet account. So here we know that we're going to have to credit prepaid insurance, because we can see that in the T account. And we're recording insurance expense,
So we debit
which
that.
we already identified. Yeah, so we're increasing an expense, so we're going to debit it. So when we've done this journal entry, so first of all, if you notice, this is you have an expense account and then you have a balance sheet account. When you're done with this, on our balance sheet, our prepaid insurance is going to be lower. That asset is going to be worth $1,860. And on our income statement, we will have recorded $4,140 of insurance expense. Are we good here?
Yep.
All right, the next one is, now we're looking at office supplies. This is going to work the same way. So office supplies account had a $250 debit balance at the beginning of the year. So we're going to say,
The mic
my
is
office
making that noise again.
phone while I'm on here. Did that make it stop?
It stopped.
Yep.
Okay. Office supplies account has a $250 debit balance. I'm going to take, here's my office supplies, and I know that I have a $250 debit balance. So that means that at the beginning of the year, we had $250 in office supplies. $2,680 of office supplies were purchased during the year. So when we purchase office supplies, it's an asset. We increase it with the debit. So during the year, we bought $2,680 worth of office supplies. The December 31 physical count showed that we have 295 available at the end of the year. So the math is a little bit more complicated because we have more numbers, but we're still trying to figure out how we got from, reaching for my calculator, we had 250, and then we add 2,680 because we bought that. We subtract 295 because we still have that. So in order to get from where we started to where we ended up, we have to credit $2,635. What does this $2,635 represent?
An expense, what we have to,
It is an expense. What kind of expense do you think? How about we just call it office supplies expense? It represents the supplies that we've used. So we're going to increase our expense. So we're going to increase office supplies expense. Okay, supplies expense for $2,635, and we're going to decrease our office supplies account $2,635. So when we're done with this, on our balance sheet, the supplies account now has a $295 balance. And on our income statement, we've recorded an additional $2,635 for office supplies expense. Are we good with these three so far? Kind of. Your faces aren't convincing me.
No, we're good.
All right, so the next one. 1/4 of the work week related to $11,000 of cash. 1/4 of the work related to $11,000 of cash received in advance was performed this period. So the first thing that you have to think about is, okay, so what happened before? So what's happening now is we've performed work that they gave us $11,000 for before we ever did any work. So you have to think, what was this $11,000? When we got that $11,000, so before, okay, this is not the adjusting entry, before we received cash and we had a liability, unearned revenue. So the cash was $11,000 and the unearned revenue was $11,000. That's where we were before when they gave us the $11,000. So we know that we have this unearned revenue account, that's a liability, that has an $11,000 balance. That's where we are when we start. Now, when we start looking at this, it says, okay, 1/4 of the work related to that was performed, okay? So we're gonna take $11,000 times 25%. So we have earned revenue of $2,750 that we have not recorded. Does where I got that make sense?
Mm-hmm.
Yes.
Okay, so we've earned revenue that we have not recorded. So we need to record it now. So we're going to record the revenue and we're going to reduce the unearned revenue. So our two accounts, we're going to have a revenue account and the unearned revenue account. We have to, so let's see, if we have revenue and we have unearned revenue. Did revenue increase or decrease?
Increased.
Increase.
It increased, we've earned it. What about unearned revenue? Did that increase or decrease?
Increase.
Decreased.
Unearned revenue?
Decrease.
Do we have more or less?
Oh,
The
we
li-
have
do we-
le- we have
We have less
we,
because
Yeah,
we
we need to earn
perform
more.
part of it. Yeah, so
Just a
now we
quarter.
only owe them, right, now we only owe them 3/4. So unearned revenue, our liability, which I'll now write down there since I keep saying it, went down. And revenue is kind of self-explanatory since it's revenue. If I increase revenue, do I debit it or credit it?
You credit.
credit it.
Credit. If I decrease a liability, do I debit it or credit it?
Debit.
Debit.
Yep. So I'm going to debit unearned revenue. For $2,750, and I'm going to credit revenue for $2,750. So now the liability on my balance sheet for unearned revenue will go down, and on my income statement, I will have increased my revenue $2,750. Are we good here?
Yep.
Okay, prepaid insurance. Good news, we've already looked at one of these. All right, so prepaid insurance. So the first thing we want to do is figure out, where do we stand? So I'm going to use my T account to give myself a picture. The prepaid insurance account had a $5,300 debit balance at December 31st, 2017 before adjusting for the cost of any expired insurance. An analysis of insurance policies showed that 3440 had expired. Oh, they're going to give us that. They gave us 3,440 was expired. In other words, used. So they actually gave us the amount of the insurance expense. See how the last time they said, this is what the balance is, the unexpired amount. This time they said, this is the expired amount. Expired is your expense. It means it's been used up. So we're going to record insurance expense for 3440, and we're going to reduce our prepaid insurance, our asset, 3440. So now on our income statement, the insurance expense is there, and on our balance sheet, the prepaid insurance went down. Are we good here? Okay. All right, now wages. Nothing happened before with wages. Wages are one of those adjusting entries that we're doing simply because we haven't recorded it yet. So just because we haven't recorded it yet. So let's say it's the last day of the month. Even if you get paid on the last day of the month, does the company still owe you money? If you got your paycheck on the very, yeah, they still owe you money. They probably owe you a week, maybe 2 weeks of pay, but they still owe you money.
Oh.
So the company will typically record that expense when they run payroll. But every month, at the end of the month, there are amounts that need to be put in as an expense using a journal entry so that it's in the correct period. So all we're doing here is we're recording an expense just like we normally would. All we're doing is a journal entry to record the expense. So if we know that we have 7,000 of wages expense, we know one of the accounts, is wages expense. What's the other account?
Wages payable?
Yes, it's wages payable. I'm so happy. Did wages expense increase or decrease?
Increase.
Mm-hmm. And what about wages payable? Did that increase or decrease?
Decrease.
Wait, did it? We're recording an expense that just hasn't been recorded before, and we're going to pay it later. So did wages payable increase or decrease? Mm-hmm.
So
we have the expense, right? We're recording the expense. We have an expense. It's just like if we were recording it.
You're talking about that week that they still owe you money for. Okay, got it.
Yep. What type? So we know this isn't an expense. What type of account is wages payable?
Liability.
Yep. Okay, so if I increase an expense, do I debit it or credit it?
You're gonna debit
Debit.
it.
Debit.
Mm-hmm. If I increase a liability, do I debit it or credit it?
Credit.
Okay.
Mm-hmm. So I'm going to
That's
debit
that-
wages. What?
That's how you get around, because it's a single-sided entry of the accounting equation. Because it doesn't affect the actual balance. Can you hear me?
Yeah, I'm trying to think. I'm trying to understand I'm trying to figure out where your head is.
Because you're not,
What do you
you're not touching assets. So it's not a double entry, like it's a double entry, but it's
Oh.
not on both sides. That's why you get
So-
away with it, because it's a debit and a credit on the same
Yep.
side.
So that, and yep. And so that's a really good point. So with the accounting equation, it doesn't have to be on two sides for it to balance. Here we've done nothing with assets, but with liabilities, we increased it $7,000, the payable, and we decreased our equity $7,000 because of an expense. So it still balances.
Yeah.
Yeah. So, and it's possible to have two on the asset side also, like you receive cash and reduce an account receivable.
Yeah.
That's a really good observation. So we're going to debit wages expense. Try this again. For 7,000, and we're going to credit wages payable because we're going to pay it later for 7,000. Oh, that was the first one. There we go. So look what you did. See? You've got 6 adjusting entries that you know. But no worries, we're going to practice more. Okay, M&R Company provided $3,800 in services to customers that are expected to pay the company sometime in January following the company's year end. Okay, this is another example of an entry where what happened is we have earned revenue, but we haven't billed the customer yet. So during December, we earned the revenue, but we're sending the invoices out in January. Normally, that wouldn't necessarily be a problem, except for we have to make sure that this revenue is recorded in the correct period. So since we haven't issued the invoice yet, we still have to make sure that the revenue gets recorded. So we have 2 accounts. We're going to record service revenue. And if we haven't been paid yet, what do you think the other account is?
Receivables, right? Accounts receivables.
Yep, accounts receivable. Yep. So did service revenue increase or decrease?
Increased.
Mm-hmm. Did accounts receivable increase or decrease?
Increased.
Mm-hmm. What type of account is service revenue?
Credit. Or I'm sorry, it's
No, but what
revenue.
type of account? Yep. And you're right, you do credit it. What type of account is accounts receivable?
Asset.
Mm-hmm.
And you debit.
If I increase an asset, I debit it. Yep. So I'm going to debit accounts receivable for $3,800, and I'm going to credit service revenue. Okay, maybe just revenue. Let's see what we have for $3,800. Okay, I have to run and grab a quart. I'll be right back. Look at this one and we'll see if we can do it when I get back. I'll be right back. No, I'm teaching. Okay. Yeah. Skating. Yeah. Sorry. Actually, I lied. I'm trying to teach with an incredibly upset stomach. Okay. Wages expense of $2,800 have been incurred but are not paid as of December 31st. So what two accounts are affected?
Wages expense and wages payable.
Yep. Did wages expense increase or decrease?
Increase.
Mm-hmm. Did wages payable increase or decrease?
Increase.
Yep. If wages, what type of account is wages expense?
Debit.
How about expense?
Expense, debit. Yep.
Oh.
What type of account is wages payable?
Liabilities.
Mm-hmm. So if I increase an expense, do I debit it or credit it? And you already said debit, you're correct. If I increase a liability, do I debit it or credit it?
Credit.
Did I hear a debit and a credit? So we're going to credit it. So I'm going to, okay, I'm going to debit wages expense for $2,800, and I'm going to credit wages payable for $2,800. Are we good here?
Yes.
Yes.
Yeah. Okay. Let's decipher this information. M&R Company has a $6,800 bank loan and has incurred but not recorded 6% interest expense of $408 for the year ended December 31st. The company will pay the interest on January 2nd. But the problem is that we incurred the interest in the previous year. So we have to make sure that we record the interest expense in the period when we incurred it. So we have to do an adjust the entry to record that because we would typically just record it when we pay it. So we have to make sure that we record that $408 of interest expense this year. So what two accounts are affected?
Interest expense and interest payables.
Mhm. Yes. You guys have this. You're doing great. Did interest expense increase or decrease?
Increased.
Mm-hmm. Did interest payable increase or decrease?
Increased.
Yeah.
Mm-hmm. Because we owe more now than before. What type of account is interest expense?
Expense. Debit.
Mm-hmm. And what type? Yep. No. Did you say credit?
No, debit.
Debit.
Debit. What type of account is interest payable?
Liability.
Mm-hmm. If I increase the liability, do I debit it or credit it?
Credit.
Credit.
Yep. Okay, so I'm going to debit my interest expense and I'm going to credit my interest payable. So when I'm done with this, on my income statement, I'll have an additional $408 of expense. And on my balance sheet, my liabilities will go up $400. What? Will go up $408. Are we good here?
Yes.
All right, so now M&R Company hired a firm to provide lawn service at a monthly fee of $680. So we hired a company, they're going to come and do the lawn service every month, and we're going to pay $680 a month. They're going to come this month, but they're going to bill us and we'll pay them in January. So they came in December, they did the work, we're going to pay them in January. So we haven't recorded that expense yet. So we want to. So what two accounts are affected? You're probably having trouble, and I don't know what we're going to call it. Maybe lawn service expense. Let's see.
Yeah.
Which makes
Or-
total
yeah.
sense. Yeah, lawn service expense.
Okay. Lawn services.
And payable.
Lawn service expense and lawn service payable. So we have our expense of $680. And we don't pay it now. So we have our lawn service payable of $680. All right, are we good here?
Yep.
Interest revenue again, but this time it's revenue, not an expense. So this time we have earned $380 in interest revenue from investments for the year ended December 31st. The interest revenue will be received on January 15th, following the company's year end. So we would normally record it when we receive it, but we've earned it this year. So we need to record it in the period that we earned it. So what two accounts are affected?
Interest revenue and interest receivable.
Yep. What type of account? Did interest revenue increase or decrease?
Increase.
Mm-hmm. Did our interest receivable increase or decrease?
Increase.
Mm-hmm. This is revenue. What type of account is interest receivable?
Asset.
Asset.
Mm-hmm. It's an asset. Yep, it's an asset. If I increase revenue, do I debit it or credit it?
Credit.
Revenue.
Mm-hmm. If I increase an asset, do I debit it or credit it?
Debit.
Debit.
Mm-hmm. So I'm going to debit interest receivable and credit interest revenue for $380. And the last but not least on this one, salary expense of $1,080 has been earned by the supervisors, but we haven't paid it yet. What two accounts are affected?
Salary payable and salary expense.
Mm-hmm. Did my salary expense increase or decrease?
Increase.
Mm-hmm. Did my salary payable increase or decrease?
Increase.
Mm-hmm. We owe more now than we did. This is an expense. What type of account is salaries payable?
Liability.
Mm-hmm. If I increase an expense, do I debit it or credit it?
Debit.
Debit.
Mm-hmm. If I increase a liability, do I debit it or credit it?
Credit.
Mm-hmm. So I'm going to debit salary expense and credit salaries payable. For And look at that. Look at all that you've done. Okay, this is an adjusted trial balance. From this, you're supposed to prepare the income statement and the statement of retained earnings. So the first thing that I would do when I'm looking at this problem is I'm going to say, okay, so I need to do an income statement first. So I'm going to do an income statement. What types of accounts are on the income statement?
Revenue and expenses.
Yep. So the way a trial balance works is it's arranged in a specific order. First, we have our assets. Then we have our liabilities. Then we have equity. Then we have revenue. And last but not least, we have expenses. It's because they're in this order that this looks jagged like this. Because the assets are debits except for the contra asset. And so this is the order that it's in. So if we're going to do revenue minus expenses, we can eliminate a whole bunch of stuff here. It's like, okay, we're not going to use the assets. We don't need the liabilities. We don't need the equity. We just need the revenue and the expenses. So now I've narrowed this down a whole bunch. So now when we go down here, okay, I'm going to have to get rid of this for now. So when we go down here, we want to put revenue in. Well, the only revenue account is the trucking fees earned for $111,000. And then we have the expenses. And what I typically do when I'm working this like this, and I'm scrolling down pages, is I'll take a picture. Well, it's only useful if you take it where it shows the numbers also. So I'll take a picture, and that way I can go straight down here. And for the expenses, it's like, okay, so I have depreciation expense, trucks, and then salaries
Salary.
expense. Thank you.
Office supplies. Repairs.
And what?
Repairs
Repairs.
for the trucks. Yep. $52,059, $14,500, and $95.46.
Thank you. Okay, so that's just an empty line. Don't forget this bottom one though, where you have to decide if it's net income or net loss. In this case, it's net income. And in this case, I would definitely check my work before I go on, because the next thing that we're going to do is the statement of retained earnings, I think. Is that right?
Mhm.
Yeah, and the statement of retained earnings is going to need this net income amount. So when we do the statement of retained earnings, remember that this is beginning retained earnings plus net income minus dividends equals our ending retained earnings. So I'm going to start by looking at what's my beginning retained earnings. And that's going to be up here under retained earnings where it says 172,930. That's my beginning retained earnings. That's what I started with. Then I'm going to add net income. So the net income was $10,048. I'm going to subtract dividends. Dividends were $19,000. So our total is $163,978. But the first thing that you have to do is go up to that trial balance and eliminate everything that you don't need so that you're not looking at as much stuff. And you think about, well, what does each statement tell you? Because they're new for you. Okay. So are we good here with the statement of retained earnings and the income statement? Okay, closing entries. Last thing I need to explain to you. I'm going to use this to explain closing entries, and then you pretty much have everything you need. Okay, so great, 3%. Wonderful, wonderful. I'm going to be a helicopter. Gosh, I can hear it too. Okay, we're just going to pause. We're just going to pray. Okay, so when you do closing entries, what you're doing is you're going to make your goal is to make the revenue and expense accounts zero and put them into retained earnings. So actually dividends too. So there's four steps, and it's easiest if you see it on a trial balance to walk through them. So the first step is you're going to close revenue to retained earnings. Which is actually what you're doing when you do the statement of retained earnings. You put net income into retained earnings. So if we want to close revenue to retained earnings, we're going to go down here. So the first thing you're going to do is you don't do anything to permanent accounts. Permanent accounts are assets, liabilities, and equity, except for dividends. So these are permanent accounts. So we're not going to do anything with these. You can't reduce cash to zero. That wouldn't make sense. What's wrong with me? All right, so these are the accounts we have to deal with. So here is revenue. This is our trucking fees earned. That's our revenue account. If right now I have a $111,000 credit, what do I have to do to make it zero?
Debit it.
Debit a lot.
I have to debit it. Yep. Mm-hmm. So I'm going to debit trucking fees earned. And I'm going to credit retained earnings. For that $111,000. When I'm done with this, what is my balance in my trucking fees earned account?
I'm sorry, say that one more time.
When I've done this entry, what is my balance in my trucking fees earned account?
It should be zero.
It's zero. Mm-hmm. Yep, this one is now zero. Okay, the second thing I have to do is I have to close expenses to retained earnings. Now, I have to close each expense account. So here are my expenses. If my depreciation expense is a debit balance, what do I have to do to make it zero?
Credit.
I have to credit it. So each one of these, I'm going to credit. So I'm going to credit that $24,847. I'm going to credit salary expense, $52,059, and office supplies expense, $14,500, and repairs expense, $9,546. And I'm going to put that into retained earnings. Which I'm going to do by adding them all up. So 24847 plus 52059 plus 14500 plus 954.
100,952.
Thank you. 100,952. All right. When I'm done with this, each one of these accounts has a zero balance. And it's in retained earnings. My third step is going to be to close dividends to retained earnings. So now I look here, here's my dividends account. What do I have to do to make dividends zero?
Credit.
Credit.
Credit 19.
Yep.
I'm going to credit dividends. So I'm going to credit dividends, 19,000, and I'm going to put it into retained earnings. So I'm going to debit retained earnings, 19,000. So when I'm done, now dividends has a zero balance. So now my revenue, my expenses, and my dividends are all in retained earnings. So that's what you're doing when you do this problem. So here, we're going to close the revenue account. So in this case, our revenue is our net sales. So see if I can make this small enough to do it all in. So it was 1,898,622. All right, so what is the normal balance of revenue, a debit or a credit?
Credit.
Credit. So to make it zero, I have to debit it. Oh, we're going to use the income summary. Okay, you're going to do this two different ways. I'm going to go back here so you can see this. So the second way of doing this, and you're going to have problems with both of them. The second way of doing this is we're going to use what's called an income summary account. An income summary is an incredibly temporary account. Using income summary, we're going to close revenue to income summary instead of directly to retained earnings. I'll show you why. And then step two, we're going to close expenses to income summary. 3, we'll close income summary to retained earnings. And then 4, we'll close dividends to retained earnings. Now, this income summary account, here's what happens with the income summary account. So revenue is normally a credit balance. So to make it zero, we debit revenue and we're going to credit income summary. So this side of the income summary account is where our revenue goes. When we close our expenses, we're going to debit their debits. We're going to credit them and we're going to debit income summary. So using this income summary account gives us a good check figure for doing this manually, because if we have revenue and expenses, the total is our net income. So it just gives us a check figure. Then we just take the balance and income summary and put it into retained earnings. So it's kind of this intermediary step so that we have a check figure. This is the one thing that I still teach that I've never seen done this way, because everything's computerized. So if we went to this, so we have our sales. So we're going to take our revenue is normally a credit. So to make it go away, we're going to have to debit it. We can put this into income summary. Make sure they want me to use the income summary account. Yeah, okay. And then the next thing that we're going to do is we're going to close the expense account. So expenses are normally a debit. So to close them, we have to credit them. So we're going to debit the income summary account. And we have to credit each one of these. So cost of sales, 1384981. Advertising expense, 117608. And other expense, 398844. Wait, what's it
That
not
last
happening?
one was just
Oh, I didn't put in the
right?
income summary total. Yep. 1384981 plus 117608 plus 398844. 1542433. There. Now it'll. Did I add it up wrong? I must have. Oh, what did I do? Cost of sales, other expense. And I added it up wrong. Let's try this again. 1384981 plus 117608 plus 398844. Oh, what happened there?
Yeah, I got 1.901433.
Yeah. What did I do? What is the problem with this entry? No, nothing. Okay. Okay, and here you have to prepare a classified balance sheet. So a classified balance sheet breaks out the assets and liabilities into current and non-current. So when you do this problem, you still want to look at what applies, and we can see that from here down, these don't go on our balance sheet. So now we can look at this and we can say, okay, the assets go in the order of liquidity. So on the trial balance, they're already listed in their order of liquidity. So we can just start with cash, and you're just going to do 9,300. This is going to be current assets. So cash. Okay, so current means you're going to use it up within the next 12 months. So accounts receivable. Office supplies. Okay, truck, we're not going to use that up in a month, in a 12 months. So trucks is not a current asset. So these are blank lines, so there's our total current assets. Now we're going to do plant assets, because that's what, yep, that's what truck is. So truck is 180,000. Less the accumulated depreciation, which is 37,080. So our net, wait, does it do our net? Accumulated depreciation, total plant assets, total assets. So we're good with that. Now our liabilities, we're going to have our current liabilities. So we're going to go up here, we're going to start. So, oh wait, we have land too. That has to go there. Land is 47,000. Land does not get depreciated. Land does not get depreciated because it has a an indefinite life. So you can't divide it up for its life. All right. So current liabilities. So the first liability is accounts payable,
I'm sorry, I have one
13,000.
quick question.
Yep.
At the top for the current assets, why are they shown as credits instead of debits?
No. These aren't credits and debits. These are
Okay.
columns and totals. So first of all, their dollar signs are like start adding up here, stop here, it's a total. But like
Got it.
notice on plant assets, this is like a column to do a subtotal to put it over here. These are not debits and credits.
Okay.
Yeah, when you look at the financial statements, the columns are for adding up. They're not debits and credits.
Okay.
Good
Yeah,
question. I'm
'cause the-
so glad you asked that.
I was just looking at the example in the book for the classified balance sheet, and they were all in like the credit or the debit column. So I was just curious.
No. Those are all these are like Excel columns. That's it for like adding up. And this is like a typical format where like we have 180,000 minus 37,080. So that's 142,920. And we keep adding up over here. Same with the like income statement, you'll have the list of expenses and then total expenses over to the right. Yeah, it's just a format for a report. Good question. I'm so glad you asked that. All right, so this is accounts payable. And then the next liability is interest payable for 8,000. And then, okay, long-term notes payable, that obviously is not a current liability. So this is our total current liabilities. And now we have our non-current liabilities, long-term liabilities. So we have our long-term notes payable. which I think was 40,000.
Mhm.
Yep. And that's our only liability. So that's going to be it for our liabilities. Now we have equity.
Common stock.
Yep. How much is that, by the way? 17,000. And retained earnings.
153.
155, 153.
Mhm.
So total assets are 233,003. Uh-oh, we did something wrong. What did I do wrong? That's what I thought. We have to figure out retained earnings. So they gave us, that's what I thought. So they gave us the balance sheet, classified balance sheet, use the above adjusted trial balance. No, it is adjusted. So on our trial balance, we haven't adjusted our retained earnings. So the one thing that you have to do here is you have to figure out your ending retained earnings. So we know that we have beginning retained earnings plus net income minus dividends, right? Gives you your ending retained earnings. So what we're doing here is we're going to say, okay, our revenue was our trucking fees earned minus our expenses. So our net income is going to be 122,000 minus 23,917 minus 66,364 minus 6,000 minus 12,169. So our net income, so our beginning retained earnings is 155,153. I got that right here. Our net income is 13,000. Thank you. So we're going to add 13,550, and we're going to subtract the dividends of 14,000. So 155,153 plus 13,550 minus 14,000. 15. Thank you. So let's try that. 154,703.
There we go.
Now
That's right.
233,003, 233,003. So we know we're good. Okay. We're going to just real quick, got kicked out. Yep, I did. We're going to real quick just look at the next practice to make sure that I haven't missed anything, which I'm sure I haven't because it's all chapter 3. And then the nice thing about reviewing for the week 2 quiz is we just work a whole bunch of problems again. So you should be doing much better. This is the only thing you have to know about the cash flow statement. So with the cash flow statement, all you have to be able to do is classify operating, investing, and financing. So operating is like anything that you do to operate the business. Investing is buying plant, property, and equipment, selling plant, property, and equipment, or making an investment. Financing is like borrowing money from a bank or selling stock. So if we paid interest on the debt, that's actually operating. If we pay cash for a building, is that operating, investing, or financing?
Investing.
Investing, it's investing. Paid cash dividends from, we received cash dividends from investments. That's going to be, yeah, investing. Paid cash for utilities is operating.
Activities.
Cash for salaries. If we issue stock, that's financing. Rent is operating. Paying off debt is financing. If we buy an investment, that's investing. Received cash from sale of equipment at a gain. The gain doesn't matter, but receiving the cash from equipment does. That's an investing activity. So that's like the total that you have to know from that chapter. When you're doing this problem, think about what is on your books and what you need to take off. So the income statement reports depreciation expense. Shouldn't have to do this one. Beginning balance, ending balance, accumulated depreciation. Okay, complete the general ledger accounts to calculate the cash received from the sale of furniture. Why is this even here? So the beginning balance in furniture is 2016, is 188,500. The ending balance is 135,000. So what we know is that we had to have gotten you don't have to do this one. Why is this even here?
Okay.
Hold on. Okay, you don't have to do this one. This is beyond where we are right now. Okay, the next one, the next two, all we're doing is we're taking, you have these different cash flow items, and we're just trying to figure out, do you have a cash in